Good morning, everyone. Welcome to our second in the series of our private equity webinars. This one's entitled Knowing Your Next Move, Getting Your Business Ready for Sale. So I'm Sebastian Stevens. I'm the National Leader of Private Equity here at BDO. And I just wouldn't mind starting with a few housekeeping items, if possible. First one is you're all automatically muted. But we'll be accepting questions as we go through the seminar, and you could submit those via the question tab. The second is we'll try to get to as many questions as possible, but if we don't, we'll follow up with you and we'll come back with a response to any of your questions that you've submitted. Last thing is, if you're experiencing any technical difficulties, please click the support button. It's one of the bottom tabs on your screen. And I just should mention as well that this is being recorded and all the registrants will receive a follow-up email containing the slides, a link to the recording, access to register for future sessions, and the speaker contact details for myself, Daniel, Marcus, and Chris. All right, so I might start by saying I'm joined by Marcus Leonard. He's one of our BDO corporate tax partners here. I'm also joined by Chris Catanzaro. He's one of our BDO corporate finance partners. And we're also lucky to be joined by Daniel Scotty. And Daniel is a capital markets and M&A lawyer and a partner at Minter Ellison. Welcome, guys. So in our last session, we gave an overview of the whole sort of private equity world and process. But today we wanted to delve a little deeper into the sales process. So to get started, and just so everyone can sort of feel part of the process, what we're going to do is open up a poll. And what we wanted to ask is whether you're planning to get private equity investment. So that should show up on the screen at the moment. So if you don't mind spending a couple of minutes responding to that, that would be very helpful. Okay, while we're getting responses, Daniel, I just might turn to you to start with. Look, the sale of your business, it's a major decision for any founder. Can you give us a little bit of a background as to, what are the differences if you're selling to private equity or whether you're selling to a trade buyer, and are there any differences?
Yeah, thanks, Seb. Look, it's great to be here today. Yes, there are differences. I mean, at a very high level, they're very similar elements to the process. You ready your business for sale in the normal way. You enter into documents that look fairly similar. But one of the key differences is that the management and founders, depending on the nature of the business and the stage, generally speaking, remain involved after the sale. So that brings a different dynamic to the negotiations, what you put in the documents, and the life of the company afterwards. The founders will have to approach it with a bit of different mindset, understanding that they're going to remain involved. They'll have some oversight from another stakeholder who's involved, who hopefully should help. But they are there. Their interests can be different at times, but generally speaking, what you want to do is find a partner who is broadly aligned. So there can be some differences, as I say, and we'll get into it in more detail as we go along. It does mean that there are differences in the documentation. What it looks like afterwards is different in terms of you're now a minority. You'll look to have minority rights in shareholders agreements and that sort of thing. And also positioning the business is a little different as well, just having regard to the fact that you will remain involved. You'll have a role in the business. It changes slightly from being the sole driver of the business, though.
Yeah. Okay. Now, it looks like our poll is sort of starting to take shape, which is really quite interesting. Are you looking for private equity investment? No is the leading response. So that's quite amusing. But I think also it probably reiterates why we're doing this. I think there needs to be some education around private equity and how it can add value. So I think that sort of warrants the process. Let's start with talking about the broad sales process, to private equity. And a question for you, Chris. Chris is our corporate finance partner. Why do we bother to get a business ready for sale? So why do we actually spend the time, preparing that business?
Yeah, thanks, Seb, and good morning, everyone. Well, really, look, a good sale process is really designed to try and help you maximize value. Or maximize your chances of success, I suppose, whilst also minimizing stress. That's probably, a good way of describing it. Because, when you do embark on a sales process, I think the one thing that, becomes immediately evident is that it does create a huge demand for information from, the potential investors into the business. And so, the sale process is really designed, I suppose, to help, prepare you, for that eventuality. So it's really designed to help you, get your affairs in order and start to collate as much information as possible, well in advance of actually, entering into discussions or negotiations with any potential investors or buyers of the company. It's as I say, it's really about helping to take as much stress off you as is possible. So because a lot of founders, a lot of owners of businesses have to continue to run the business, whilst also going through a sale process. So it pays to be prepared before you sort of embark on that process.
Yeah, I think so. I think the other thing that's important, I suppose, to just touch on here is that when you're looking at a trade buyer, they obviously know the industry, they kind of know the business, and they're probably more focused in on where the synergies are and how you can leverage those. With a private equity buyer, given that they're more of a passive investor, so to speak, are there different things there that you would look to sort of demonstrate to private equity? So when you actually look at the information memorandum and the types of information you're preparing, are there certain things there that you hone in on that a private equity firm is mostly looking for?
Yeah, so I think, from a private equity firm's perspective, maybe one of the key things that will differentiate one company from another is the strength of the management team. So, if you have a business that's, overly reliant on one key person, for example, that may introduce risks, to the business that perhaps private equity firm is, less comfortable with. Because, from the private equity firm's perspective, they're investing in the people as much as they are the business, because, as you rightly say, in a lot of cases, they're not going to be involved in the day-to-day operations of the business, and so they will need to place a lot of reliance on that management team. And if they perceive that it's perhaps not as strong as it could be, or there are gaps, or as I say, it's overly reliant on one key person, that may introduce risks that they're not comfortable with, and could potentially lead them to sort of look at other opportunities.
Yeah, okay, thank you for that. And Daniel, just a starting question for you. I think when you're engaged in this process, what are the objectives? What are you there to do?
Yeah, look, what we try to do is probably twofold. One of which is to help the vendor and the target company put their best foot forward in terms of presenting themselves as an attractive opportunity. And some of the comments Chris made go to that around management, but there's also a piece just around the documentation, making sure it's all tight, watertight, accurate, and so on, and also being transparent. Seb, as you mentioned, the private equity players are generally not competitors, so you can be perhaps a bit more fulsome in your disclosure, knowing that that it's not necessarily just a fishing exercise to get your best secrets and then use them against you. And then that plays into the next objective, which is protecting the shareholders from liability. So obviously that full disclosure means that any warranty regime is qualified by all of that. So those are really the main objectives. That, and then of course, when it comes to the documentation phase, it's all about documenting the deal that has been agreed in an accurate way, making sure it's not too off market, making sure the sellers understand what they've agreed to, and that any management or founders that are continuing on know what their obligations are going forward.
Yeah, thank you. All right, so Marcus, I think a question for you, sort of tax obviously. Why is this tax position or the structure important in the sales process?
Well, from the outset said, why tax comes important, you do have two competing interests. One, you have a vendor who's looking to minimise their tax exposure on an exit, and you've got a purchaser who have other tax outcomes they will be looking for. Having said that, what you'll generally find in a process is you need to get alignment. Transactions don't normally work unless both parties are getting an efficient outcome from tax. So what that may lead to, it may lead to some pre-transaction restructuring. And the reason for that is a number of reasons. When you're looking at private equity, generally these days you don't divest 100%. So if you're rolling over equity into the fund or the fund group that it's already set up, you need to get efficiencies and access certain things like CGT rollover.
Yep, brilliant, thank you. All right, that was just sort of a bit of a touching on the broad sales process. What wouldn't mind delving into now is sort of the value drivers. So how are you going to drive value through this process? Obviously, that's sort of leaning on you, Chris. You know, again, I want to hone in on this because I think it's important that we understand what buyers are looking for when they're assessing value in a business. So is there any input you can give us on that one?
Yeah, so I think, you know, the first point that I would make is that, you know, it helps to you know, have the right thematic, I suppose, which is to say, you know, it obviously helps if you're in an industry that's experiencing tailwinds, I suppose. So, you know, I guess, you know, we're all aware of certain industries that are perhaps attracting more interest from investors than others. And so, you know, if you're benefiting from those sort of, you know, broad industry trends, it's kind of, you know, important to make sure that you're, you know, sort of taking advantage of those as best you possibly can, and sort of, you know, sort of demonstrating to bidders, you know, that you're in that space. The second obvious thing, of course, is you know, the financial metrics. So, you know, I guess, you know, traditionally, you know, that's been things like earnings and, you know, being able to sort of generate strong margins. But, you know, as we've seen with you know, certain companies, particularly in the tech sector, it can also be, you know, things like revenue and the growth that you're experiencing in that revenue. So sort of being able to tick those boxes is obviously important. And, you know, I think linked to that is, you know, an ability to kind of articulate, you know, what your key competitive advantages are, you know, as a company. So, you know, what is it about your company, I suppose, that, you know, provides you with that, that sort of competitive advantage that is sort of difficult for other companies to kind of replicate. So, and that can come in a number of different forms. It can be, you know, you've got a strong brand, or it might be that you have, you know, the premium product in a particular marketplace that others just can't seem to match, whatever it might be. But it's important to sort of be able to point to something, you know, in that regard that, you know, really underpins the kind of, you know, the earnings growth, I suppose, or the revenue growth that you might have sort of achieved over the past. And then, you know, obviously it's, you know, it's important to sort of be able to, you know, articulate where the future growth opportunities for the company might lie. So, you know, you might have experienced growth over the past few years, and that's great. That definitely ticks the box. But it's also important to sort of be able to demonstrate that you think the company will be able to continue growing, you know, in the near term and over the longer term as well. So, yeah, you know, that's also important. And, you know, as we've already mentioned, you know, I think key to all of that is, you know, having a strong management team, you know, in place. You know, if you sort of can sort of demonstrate to people that you've invested in a strong management team, you know, particularly when it comes to dealing with private equity players, that will generally also sort of yeah, help to enhance value.
Yep. I think just one of the other things, I suppose, that we're sort of seeing a lot lately is that the private equity really honing in on that free cash flow. You know, obviously keen to understand the earnings of the business, but also keen to understand what the cash flow profile is of that business.
Yeah.
I think the other thing that you mentioned, you hit on, which is pretty important actually, is that, you know, typically a sale to private equity, it isn't a full sale, obviously, and we've spoken about that. But the outcome of that is that there's a bunch of capital that comes into the business that effectively the private equity fund wants you to use wisely. So I think you're right that when you're dealing with the go forward position, it's around how are you going to execute the strategy, because, you know, a private equity fund is going to look for their return over the next 3 to 5 years. And it's really how you're deploying that capital. What are you growing? How are you growing it? And it comes back to that management team executing, as you said.
Yeah.
So yeah, if we move past that one, I suppose the next question is that, you know, realistically, once we've actually started looking at the business and analyzing its financials and making sure we're getting the business ready for sale, you're ultimately trying to get to the position where you've got a selling document, an information memorandum. Any chance you could walk us through, you know, why do we need an IM and what sort of things do we need to include in that IM?
Yeah, so an IM, I guess, is essentially a document that, you know, explains the business to potential purchasers. That's sort of how I think about it, I suppose. So, you know, it is a selling document, so you know it does, I guess, present the business in the best possible light. But it is also important, that the document is truthful and accurate and complete. So you don't want to be misleading in any way. But it is important that you are, I guess, articulating what is it that makes this particular business great, and what are the opportunities that somebody might be able to benefit from. Really at the end of the day, you're looking to kind of provide buyers with enough information, I guess, to make a reasonable assessment of the business and its prospects. And that doesn't mean that you're giving away all your sensitive information. So you're not necessarily putting all your customers in there and all your your trade secrets, but you are, I guess, putting enough information in that document to enable people to kind of form a bit of a view on whether or not this is an opportunity that they'd like to find out a little bit more about. So the key sections, I guess, of the document, obviously there'll be a bit of an overview of the business and perhaps the industry in which it operates, if the tailwinds are favourable, as I sort of mentioned earlier. Some high-level financials will also be important, and as I sort of already indicated, like articulating those growth opportunities. It's great to understand what the business has been able to achieve up to this point, but it's also really important to sort of be able to articulate where it's going and what the strategy is for the business moving forward. And then, oftentimes in IMs as well, there will be a section where you kind of basically outline the ask. So that is, what are you looking for from the investor, and what do you intend to do with that capital that they provide to you? So, and again, that's why, being able to sort of outline those future growth opportunities is really important, because basically, in a lot of cases, you're asking for the capital so that you can go after those opportunities and realise the value that sort of exists within them.
Yeah, I think that's spot on there. I think the question I've got actually for Daniel, I mean, obviously a selling document being a prospectus when you go into the public capital markets is heavily governed. Obviously some liability around that. What's the difference when you're actually looking at an information memorandum for a PE fund?
Yeah, thanks. So there's a couple of differences. Number one, you're less constrained in terms of what's actually required to be in there. So Chris gave the outline of what's typically in there, but there is a degree of flexibility around that. Some people like to put more, some people like to put less. So there's no particular rule on that. In terms of liability, look, it's not as egregious as a prospectus, which has a really strict regime, although there is the due diligence defence in that context. In the IM context, there's still potential liability for misleading and deceptive statements. So it's obviously important to get the prospectus right. Yes, it's a selling document, but let's not go over the top. Just give it to me. I'll take out all of the adjectives. But you can exclude the liability to some extent in the long documents, but you don't want to be relying on those sorts of provisions. So I think it's important to get it right and get that balance between selling and not going over the top right.
Yeah, thank you. And Chris, quick question back to you. I think we're sort of noticing quite often with our clients that private equity is not really that well understood. There's a little skepticism around that. My experience is overwhelmingly positive the other way, but obviously we see a lot of these deals. Can you give an example of where you've actually seen a pre and post private equity deal that has made sense to you?
Yeah, so probably a good example that I can point to, and one that's kind of topical, I suppose, at the moment is Baylor's investment in SiteMinder. So some of you might have seen that company listed recently. Baylor actually is sort of a long-standing client of ours. They initially invested in that company back in 2012. And I guess the initial investment was about $5 million. That's what they initially put into the company. And that capital was really invested so that SiteMinder could expand, I guess, more aggressively into Western Europe and Asia. At the time, we sort of really started, getting involved with the company. It was sort of back in 2014, and SiteMinder, we were sort of charged with doing some initial kind of valuation work for Baylor as part of their, I guess, regular sort of portfolio process. And when we first started looking at SiteMinder, I think they had about $20 million worth of revenue, and a sort of evaluation of about $150 million. So it was a sizable company, but it was still kind of in the early phases of its growth cycle. The last valuation report we did, they had revenue of about $100 million and a valuation of about 1.1 billion. So that was sort of in the middle of this year. They recently just listed, so some of the listeners might have seen this. They listed for $5 a share just recently, which gave them a value of 1.3 billion. But immediately upon listing, their share price jumped $2 and gave them a market cap of 1.8 billion. So that's quite a story, quite a growth trajectory. So from 2012 through to now, from a $5 million investment and maybe an initial value of sub $100 million up to $1.8 billion is pretty amazing. But the thing that I will draw out there is that Baylor played a very hands-on role in kind of helping the company to kind of expand into those new markets. They had 2 people sort of join the company's board, in the early days of its expansion. And the benefit that those 2, I guess Baylor directors brought to the company was a whole wealth of commercial expertise that I think really benefited SiteMinder during that journey. So one of the Baylor founders was the ex-head of Champ Private Equity. The other one was the former CEO of Fairfax, David Kirk, and ex All Black captain, for those of you who are rugby fans. So they brought a lot of leadership qualities to the business, and really helped to sort of steer them through those those early days of their expansion. And even now, Baylor, even post the listing, Baylor actually still remains their second largest shareholder. So whilst they've sort of realised the value of a lot of their early investment, they're actually still in there, as a backer of the company. And throughout the process, actually invested more than just the initial $5 million. Continued to provide further capital along the way as well. So I think it's a great success story, and it sort of shows how an early kind of investment from private equity and all the commercial support they can provide can really sort of help to pay dividends over the long run.
Yeah, no, that's overwhelmingly our experience as well. But I might just, given the time, I sort of might move on to sort of talking about structuring the deal. I know we keep hearing people talk about structuring the deal. I might start with you, Daniel. What does that mean? What are you structuring, and why is it important?
Yeah, sure. So look, different people, I guess, can mean different things. I think of it as being, what are you actually doing? What are you selling? Are you selling all of the company, part of the company? Are you getting an investment? Is it the existing company? Is it assets? Are you interposing a new entity? Are you doing something else? Is it a royalty or a licensing arrangement? There are potentially all manner of interesting, weird and wonderful things, principally driven by my friend to my left here. Lots of tax considerations in terms of how the deals actually come together. Now, at a commercial level, it's pretty clear as to what you want to do, getting investment, selling a part of the company, but there are potentially all manner of different ways that can play out. So Marcus, there are lots of drivers on all of that from your side of things.
Yeah, there is, Daniel. When you're looking at structure and just taking what Chris was talking, something you see quite, which is quite familiar with PE, they're looking to take businesses or help them grow, and that'll be global. So when structure comes into it, you need to look at it. It's not just Australia they're looking at. They're looking, do I take the business to the US? Am I going to take the IT to Europe? What does that mean? So what the structure means is you move from maybe a typical Australian only entity, then become part of a global group. And that might mean setting up new entities offshore or becoming part of a merged group that has offshore entities. So structure, I'd say, usually a lot of businesses start in Australia. The SiteMinder is a good example. It started locally and went global. And with a lot of PE funds, their main mantra these days is, if you've got a great business or opportunity and it's doing well in Australia, 9 times out of 10 it'll do well in global markets as well that are better. And that's why structure becomes really important. As I said at the outset, there's 2 competing parts. The purchaser's looking at their structure and what gives good repatriation to their stakeholders. But as a vendor, you also need to ensure that you get a good tax outcome if you exit a portion, and also call the tag along as you go along with the new structure. Do you get tax efficiencies as well, and what does that mean?
That's important. I think we spoke a little bit before about, private equity always back strong management teams. Obviously they're sort of passive shareholders to a certain extent, although they will be active on the board, etc. How do you keep your management team intact? So, given that there's some risk associated with management teams walking out, that's a question for you, Daniel, to start with here, is that, how do you actually incentivize management and align management with those shareholders, especially the new incoming shareholders?
Yeah, thanks. So that's a great question. And there's a couple of different elements to it. We mentioned at the outset that these deals typically involve management or the founders remaining invested in the company. Obviously, having that investment and retaining that, it inherently aligns the two parties to some degree. And then you can put or the private equity firms usually like to put some constraints around the ability of the founder to sell down. At a minimum, there might be some sort of minimum hold period. If the founder wants to sell, they might have to go through a preemptive rights regime and all that sort of thing. Then beyond the existing hold, of course, everyone likes the opportunity to make more money, and that's where management equity schemes come in. And there are all sorts of options available there, which I'm sure Marcus will talk about in a second, that really drive that alignment even further. So obviously, to the extent that the management is able to hit targets and perform, then obviously they will get a share of what some people call sweat equity.
Yeah.
Marcus, would you like to talk about some of the?
Yeah, that's a good point, Daniel. What you generally find with a lot of private businesses, there's not a key management plan set up or an equity scheme set up for management. And one of the key things that you'll find when a PE fund comes in, typically they've already got a well-established, what they refer to globally as a carried interest program. And the practicalities of this, or what the incentive is to get key management to have a part of the business and to share in the growth. The key part of this is to really, at the mindset you need to be mindful of, is when you give equity to key management, and we typically in Australia refer to as employee share scheme, you don't want to give them a tax obligation with no cash. So the way you actually establish this key management plan or incentive plan is quite important. There's various ways you can do it. You can do it by a loan arrangement. You can do it by various other mechanisms. There may be options. So that is something to look at. And what it does is, from a commercial perspective, it does lock, the PE fund will want to lock in the management because they're investors. They're not there to take over the business. They're investing in the growth of the business, which is a key part. And you need that key management to continue.
Yep, thank you. All right, I think I might sort of keep moving into what we call vendor due diligence. So whether it's formal or informal, typically there's some level of vendor due diligence. And what I mean by that is that we, the accountants, the lawyers, etc., would look at the business that's getting ready for sale and almost play a role as if we were the acquirer in understanding the financial, tax and legal issues associated with the business. I want to jump straight to Daniel again, but why is it important to go down that process?
Yeah, look, I think there's a couple of reasons. One of which is, sort of jumping forward a little bit to the negotiation of the documents. The private equity firm and its advisors will do very detailed due diligence, and they'll turn your company upside down, inside out, and back to front, and look at every single document and ask lots of questions. And so they'll get to know you pretty well. In order for you and your advisors to be well placed to negotiate documents, you don't want anyone to be surprised by some issue that the private equity firm has identified that you might not be fully aware of, or certainly the advisors might not be fully aware of and have not fully thought through the implications. So the vendor due diligence minimises those surprises. Secondly, and sort of going back to the beginning of the process, it gives an opportunity to fix up any little snarls that could turn into big snarls down the track. And indeed, the private equity firm and its advisors might identify, and they might think, well, that's an issue that goes to value, and so therefore I'll knock something off what I'm prepared to pay here. And a really good example is, something as simple as the IP arrangements in a firm where, in a company where IP is really important. You know, the company might not in its early days have been so careful about you know, assignment clauses in employees' employment contracts.
Yep.
In the early days, you know, you're growing fast, your attention is on, you know, sales, all of that sort of thing. It's perhaps not that important. Down the track, though, when someone quite sophisticated comes to look at your company, those sorts of issues are the sorts of things that they'll look at, because they want to make sure that the bundle of rights that you purport to have and purport to be selling and trading on the basis of is in fact there. So if we look at that first, we can say, oh, okay, hang on, there's a bit of an issue here. Let's fix it, and let's fix it before anybody knows that we're in a sale process, and particularly those items where there's some sort of third party, like an employee or an ex-employee involved. And if they know you've got a deal on the go and you want something from them, you know, your chances of fixing that are pretty low, or fixing it cheaply are low. Yeah. So you want to do that in advance.
Yeah, thank you for that. And Chris, back to you now, sort of financial side of things. You know, that financial vendor due diligence or vendor assist or whatever we end up doing. Can you walk us through why that's important from your perspective, and some of the things that you might see once you do that?
Yeah, so it's very similar, I think, to, you know, what Daniel just laid out there. I mean, really, it's all about, you know, just trying to be on the front foot as much as you possibly can when it comes to, you know, dealing with issues that, you know, may be uncovered, I guess, you know, during the vendor due diligence period, and or, you know, putting you in as strong a position as possible when it comes to actually negotiating, you know, on value. I mean, because, you know, what you don't want to be doing is sort of, you know, as Daniel says, uncovering issues for the first time, you know, during the negotiation phase or during, you know, the detailed due diligence phase that's been completed by the buyer. And then, you know, having to kind of, you know, defend the value that you thought you had agreed, you know, perhaps during, you know, the initial bid stage. So, you know, it's not necessarily like the vendor due diligence process is not something to be scared of or worried about. I think it's really again, you know, as I was sort of saying at the beginning of the discussion, it's all really aimed at trying to help you be prepared as possible for the process, such that, you know, when you do actually embark on the sales process and start, you know, negotiating and interacting with bidders, you know, that, you know, you have all the information to hand. You're not trying to think of, you know, responses, you know, on the fly or at that very moment. You know, you're well prepared and can you know, be on the front foot, as I say.
Yeah, I think some of the things that we see typically is that, especially with the private equity buyers, they're relatively sophisticated. So they actually want to see what is the impact of applying proper accounting standards. And so some of the things there that when we're selling, you know, private companies or getting investment into private companies, they typically haven't adopted all those standards, etc. And that it might seem like accounting mumbo jumbo, but at the end of the day, you really want to make sure you're on the front foot when there's a decent due diligence provider on the other side asking questions about your revenue recognition and the way you amortize and the way you capitalize, you know, development costs, etc. I think getting on the front foot with those things just shows that you're on top of these business issues. And I tend to find that they hone in on those things these days, the accounting implications probably more so than they have previously. So you're right, it's better to be forewarned. I think the other thing just to mention that we're seeing a lot more of now is sort of, you know, that vendor due diligence was always typically legal, financial and tax, but we're starting to see we roll in our HR guys to do HR diligence and the tech guys to make sure that there's no tech issues there. And then even the forensic guys sometimes from an integrity DD point of view and making sure there's no issues with the corporate structure in the past, etc. Because I think at the end of the day, you're really trying to make sure that it's served up on a plate, so to speak, to private equity. There's minimal issues for them to address, because that, like you said earlier, I think Daniel said it, if there are issues there or you know, everyone's sort of skeptical when they're going into an acquisition, you know, that any issues that they discover sort of loses confidence in the business, and then that can go to value. So I think that's a critical element. And Marcus, I presume it's the same for tax. It's really just making sure you're aware. Are there any issues you typically see come out of the tax due diligence?
Look, the key thing with any tax due diligence is, I'll preface saying, are your tax obligations up to date? Do you have good documented process and procedures? And do you have separation of issues that would give someone comfort if they're investing? There's a mitigation of risk of error due to the process you've got in place. Also too, it depends on the type of taxes that you have, and everyone just thinks tax due diligence income tax. We generally find where we find anomalies or errors is normally what I call the indirect taxes, which might be your GST system if you have some GST-free transaction. Or payroll tax is a good one where you have employees across the country and you have different thresholds for payroll taxes. Normally you do find some errors. The other thing to be mindful we find is if you do have an incentive plan, you know, that is all subject to payroll tax. Has anyone thought of that? The other thing to be mindful, do you have any high risk tax areas? And what I mean by high risk, not that you're aggressive, but is it something the tax office is looking at the moment? And so in the technology area, that's got a huge focus from the tax office is R&D claims. So unfortunately, you might be doing something that's quite appropriate from an R&D point of view, but it's going to get scrutinised because it's just an area the tax office is looking. So they want to mitigate their risk and have comfort that you've met those concessions and the criteria to claim them.
And continuing on with you at the moment, so when you're looking at mostly businesses that are getting investment from private equity are going to be those family businesses, private businesses. Is their structure they're currently in acceptable to a PE fund, or do you need to restructure?
Look, it's a good question. Generally, the ideal structure that most businesses or PE funds like to invest in is an Australian corporate. So I think the first question that you look at when you're looking at an investor, do I have an investor-friendly entity? Typically, in Australia, we're quite unique. We use a lot of trust structures. A lot of PE funds will not be keen to invest in a trust structure just because the way the documentation of deed is very limited and won't work for them maybe going forward. So 9 times out of 10, a corporate is an ideal structure. And it goes back to say, when I was talking at the front, you've got 2 conflicting views. If a PE investor ideally would just like to buy the assets of the business.
Yeah.
If I'm divesting, I want to sell equity because I want to get access to the CGT discount to lower my income tax for the cash portion. What generally happens is you've got to meet in the middle. You've got to protect the vendor's tax position, but also provide something that has low risk, especially commercially from a PE fund. And that may mean setting up what we refer to as new acquisition vehicle, which is a corporate, and it facilitates the transaction. So you're kind of managing the investor's tax profile and also the vendors. And so that's all manageable and it can be done. But I think one of the things is if you do not have a corporate, you need to really think, well, I'm going to have to change this. It's not the end of the world. It's not a big issue because Australia fortunately has a lot of CGT rollover provisions where you can move things into a corporate structure. One of the things that does come up and gets raised is we still do have state taxes and stamp duty is one of them. And stamp duty could be imposed in restructuring a business. Having said that, most PE funds, as they started with and are looking to buy the assets, any stamp duty costs, they generally look, that's a cost of the transaction that they would normally bear. And so you'd be reimbursed as a vendor for that.
Okay. Yeah, because I was going to ask you about whether there's anything you can do for the sellers to help their position on an exit strategy, but you've sort of answered it by saying that it's going to have to be a win-win scenario.
It does, and I think there's different stages as well. So you look at the first part of the transaction, which is the exit. As we said before, a lot of PE investors don't come in and take the whole business. It's not a trade sale. They're investing in your business proportionally. Yep. And that can be anywhere from 30% to 70% generally. So what would happen generally is you will have what I call a tag-along interest. And that may be in another entity or part of the fund. So as a vendor, the other thing you need to be mindful, how do you structure what I call your rollover equity? And we need to look at that. It's quite important that if you're moving a large portion of your equity in the business or the overall business that's merging, have I got CGT rollover? And the reason for that is the last thing you want to do is trigger a taxable gain with no cash. So it's something just to be aware of to make sure that you do meet those rollover provisions.
Yeah. And you mentioned that indirect taxes are typically where you see errors in a business when you're doing that vendor tax diligence. Are there any other areas you see that people make mistakes, as a private business that they need to clean up?
Oh, look, generally, so you'll find errors like we're all human in that, but you generally, The one thing you will find that will have to be cleaned out, it's probably not an error. It's not unusual for a private group to have a lot of loans to other related entities. And so one of the things you need to be mindful is, as you're getting ready for sale, you've got to clean up the balance sheet. And that may mean that there may be pre-transaction dividends or loan repayments to clean it up, because if you can think, of a third-party investor comes in, they just want to invest in the business, not in your history or your finance facilities that you've used between the intergroup entities.
Yep, no, very good point. All right, I think if we sort of move past that, I think one of the other areas we should sort of focus on is, how do you choose the right PE firm? Like, it's one thing to prepare all this documentation and get yourself ready for sale, but how do you actually locate the right potential PE partner? I'm going to cross to you on this one, Chris. So how do you think you find the best match between the ownership and the private equity fund?
Yeah, so I think probably the first point to make is that, PE funds themselves obviously have their own investment criteria. So, for example, some PE funds will only invest in certain industries, for example, and not others. So, there's no point approaching a private equity firm that is not interested in investing in, your particular industry. They also have, criteria around things like, the size of the company. So, for example, some of them might say they're only interested in companies with certain revenue figures or certain, EBITDA metrics, things of that nature. So, you also need to understand that. And then some investors as well have, I guess, a preference around how much they're looking to invest in a particular company. So, from the point of view of some funds, as you can probably imagine, they get approached by a lot of different people, and presented with a lot of different opportunities, and, they can't, assess them all. So, they have to have some way of sort of filtering through those. And one of the ways that they do that is by check size, I suppose. So, if your ask is too small, or in some cases your ask might be too big, then you're probably not going to be a good fit in that regard either. But I think, the other important point that I want to make is that, business owners sort of need to run the rule over, private equity funds as much as private equity funds will run the rule over businesses. And probably one of the key things is you need to sort of feel as though you can develop a good working relationship with the people sort of running the private equity fund. Personalities are key. Being able to develop that good relationship is key. Everybody sort of wants to be able to work with somebody that they like, and so that will be important. As part of the process, making sure that you can sort of get along with the people, that are sort of working within the fund. But then the other thing that's really important, I guess, is to, really think about what additional value the private equity fund can bring to your business outside of just the capital. And, it's important, I guess, that, you're aligning those things with your particular objectives. So, for example, if you're looking at expanding your business overseas, you might place a premium on a fund that has, a lot of, recent experience or good experience with, helping other businesses that are perhaps similar to yours, expand in the markets that you're targeting, for example. You might want to, partner with somebody that has, particularly good IPO experience, if that's your ultimate end game. So it's really thinking about, okay, well, what are your objectives as a business, and how do those line up with, the experience and the capabilities, I guess, of the private equity firm that you're dealing with. So, yeah, so as I say, you want to run the rule over them as much as they're going to run the rule over you.
It's actually a really good point. I think, what we're seeing more often than not now is that the businesses we're acting for, they see their ambitions as being global. And so quite often, Marcus and myself do a lot of these, is that we're actually working with overseas PE funds as much as we are local. Not to offend any of our local people, but their mandate is typically Australia, New Zealand. And so they focus heavily on that, and they're happy to expand it. But quite often, if you've got a tech company that thinks that the ultimate aim is to go to the US, then we would position them with a US fund half the time. So I think that's a critical aspect, as well as working out, well, where do you want to get to and who's best to get you there. All right. And a bit of a plug for us, but what role can advisors help in actually getting you to the end game, I suppose, with a PE fund?
Yeah, well, as I think you were kind of alluding to there, I guess, the benefit sort of working with an advisor is that they're quite often working with these PE funds on a day-to-day basis, and I guess firstly have an understanding of what they're looking for. So we can sort of help make introductions from that point of view, but also we can provide advice to our clients on the capabilities of those PE funds and sort of talk to them about how they could potentially be a good fit. And what's the benefit of that? Well, really, it's all around helping you to save time. Because as I say, there are a lot of funds out there, and and likewise, PE funds are also presented with a lot of opportunities. So I think advisors such as ourselves can really help to sort of sort through the list of potential options and really kind of help you with honing in on those potential investors or funders that we think are likely to be a good fit, which will save time. And the other thing is if we've got pre-existing relationships with some of those funds, it always helps to get a warm introduction to a fund. When you're sort of cold calling people, it's as we all know, it can be a lot harder. So if you're coming through a channel that is known to the private equity investor, then you're perhaps much more, or I would say you're much more likely to get a fair hearing, I think, than if you're just sort of approaching people out of the blue.
Yeah, I think that one of the changes I've seen during the pandemic really is that there is a lot more international PE activity in Australia than I saw beforehand. And I think I'm really not 100% sure why that is. Maybe it's because everything's VC these days, so it doesn't really matter if you're in the US or elsewhere. But the last two transactions that we've looked to sell, we've ended up selling to US PE-backed businesses. And the Australian guys were in the mix, but the offers were better from overseas. And they're not massive business. One was manufacturing, one's sort of security type business. So it's really interesting to see those guys being far more active here in Australia. And I think that, our US fund's the #1 advisor to private equity in the US. So it's pretty handy to have them sort of backing us as well. I'll sort of move forward because I am conscious of time again. But one of the things we mentioned at the outset is that the PE is not that well understood. I think the press is never kind to the private equity world, but maybe Daniel, your experience, what are you finding working with PE? And try and be objective, I suppose, in this regard, because you're obviously working for a PE fund, but seeing how it impacts the businesses that they acquire as well.
Yeah, thanks. Yeah, look, I don't think the media always gets it right. They love a sensational story. They love painting private equity as the guys who sort of pump and dump in a way in the private sense. Perhaps strip assets out and costs and then flog the company onto the next person at the top of the market. The reality in this day and age is quite different. I think private equity understands that the number of times it can do that sort of thing is perhaps limited, if it's possible at all in this day and age. And so we find them very good to deal with. They're obviously very sophisticated. They're meticulous, but they also, broadly speaking, and everyone's got different philosophies, but they, broadly speaking, look to partner with the investee companies, look to get the best out of the management, help the management to grow the business, and really set up these businesses for success going into the future, recognizing that, generally speaking, their investment time frame is a limited one. It might be 5 years, 7 years, something like that, sometimes shorter. But they work closely with the founders and management to grow the business and set up success.
Yeah, I agree with that. I think, I think the experience that we have with them is that they have learned a lot from the 90s or whenever it was, when there was a lot of financial engineering, and now they're really honed in on that backing management and just being that partner there. Marcus, any feedback from you on what you're seeing out there in terms of the private equity landscape? What's changed over the past decade or so for yourself?
Yeah, look, I think if I go back in history when I started to work with PE funds, and the methodology has changed. I can remember, and this is going back, a good 20 years ago, show my age a bit, the PE was all about building up equity. I'd be structuring around these convertible note instruments, debt equity hybrid, all to protect the return of the PE fund. And It was all about, if I look back at one business, it was all about getting scale, more equipment, get the EBIT up and sell it. And I think one business I remember I sold 4 times to 4 different PE funds over a 9-year period. And if I look back now, I never see that business anymore. Like, it used to be everywhere, everyone would see it. The difference is now, what's changed? It's not 100% buyout. There's not these hybrid instruments that go in and you laden the company with debt and you're paying huge coupon interest, so the fund's getting, twice as many the returners are. They're all about growth. So what I'm seeing now over the years, and why I see more structuring is important internationally, is one group that Daniel and I work on is basically invested in a medical provider, and it gave it capital to grow. And what it's done, it helped the business to grow. So I looked at the business cycle of this industry, and what it did is it grew the business and then merged with another part of the business cycle to further grow. And along the way, yes, you might realise some cash, but they've kept that equity interest now for a number of different transactions, where they're in a whole part of the business. So the business just keeps growing. And what they're looking for is synergies. And basically, how do you make the business grow and have, I call bolt-ons, or other part of the business in the industry that makes sense. The other thing I was conscious of that I should allude to, there were a couple of pre-questions. And one was to do with, what happens if I've got land in my entity and PE wants to invest and they're not interested in the land? And what I'd say there is, we work with the company that we're looking to invest, so you don't trigger inadvertent taxes. So just because you've got land's not part of the transaction doesn't mean we can't do the acquisition structure, so you're not triggering stamp duty on not us investing in the property and moving it to the side. There are OSR concessions for property, and we can, when I talk about rollovers, that's a choice. You might trigger the same tax free, so we can move everything in a very tax efficient way. The other thing you will find these days that we get asked a lot, I've got a company with a whole lot of franking credits, I'd like to access them, how can I access them? Well, excess franking credits is based on, basically, do you have accounting profits? But if you don't have accounting profits, there are other mechanisms you may look, and this is what's getting ready for sale. Because one thing is, if you did something like a share buyback off market, and anything that's not dividend share capital, and most private companies have $100 of share capital, it's a deemed franked dividend. So there are ways to get franking credits, and that's why I say, in planning for an investor, starts at the structure right through the end game. And it's not a one-stop fits everyone. It's a very methodical process that you go through and we work through with the vendors.
All right, thank you. And Chris, one of the things that came through from some of the questions that we'd asked of our clients over a period of time is that they see private equity as risky. Do you have a view on that and why there would be that perception?
Yeah, well, I think it probably stems back to some of the activities of private equity firms, back in the 90s and some of the bad behaviour that I'm sure we're all aware of. But I think what Marcus was saying, about current private equity investors is right. They are much more focused on partnering with businesses now and helping them to achieve their growth objectives, and doing that in a relatively transparent way. I guess, it is important to understand that, they do have, I guess, an end goal in mind. That is to say, a lot of private equity funds will obviously look to try and, realise the value of their investment at some point, down the line, whether that's in, 4, 5, 6, 7 years, whatever that might be. And that could be via an IPO or some other means. And, they will have certain growth objectives in mind, I suppose. And, that can at times, put stress on the business. If you're sort of used to growing at a certain rate, and now, you've received some capital and the expectation is that growth rate is going to continue and perhaps, increase, many times over, then, obviously that brings with it an element of stress. But, I think if you can accept that and sort of approach it in the right way, and as I say, sort of, really look to try and leverage the relationship that you develop with your, the private equity fund that's invested into your business as much as possible, it can lead to some really great outcomes, down the line. So, obviously, as I say, you need to be able to work well together, and you need to kind of go into any kind of relationship with somebody with your eyes wide open, of course. But You know, it's really a partnership now. That's really what I think you want to be trying to achieve as part of any kind of fundraising you know, activity. Is you really want to bring somebody on board that you feel like you can partner with, and that's going to, you know, enable you to take advantage of opportunities that you otherwise wouldn't be able to access by yourself, or certainly, you know, not as quickly, you know, were they not there.
I think that's a key point. I think the outcome of this, and we're releasing a private equity survey early next year, but what we've seen from the preliminary analysis is that I think everyone's aware that the IPO markets have been flying for the last 12 months or so. But probably what people don't realize is the VC and PE markets are still eclipsing those returns. So what it means, I suppose, realistically, is if you haven't sold all the shares in your business and you're partnering with this PE fund, then you're going to realize on the second exit, or your full exit, you're going to realize some of those benefits that PE is driving at the moment. And so I think that's a critical aspect here, is you are selling partially at day one, but then you're going for the ride with the private equity fund and then getting another exit, which sometimes can be even more lucrative, even though you've got less shareholding in the business. And I think, you know, the stats are bearing that out at the moment.
Yeah, well, I mean, to use the SiteMinder example again, you know, the original founders of that business still have around 13% in the company. And, you know, that's after they've sort of taken a whole lot of money off the table all the way through, you know, through the various sort of, you know, capital raising rounds that they sort of, you know, undertook. So, you know, the rewards for founders can be significant if, you know, you sort of are able to get the business humming, as, you know, everyone hopes it will once you sort of bring on board these sorts of investors.
Now, I'm conscious of time. I think the last thing I'd like to say is that I think you've hit on a good point. The way I see private equity is that it is a partnership. It is growth capital. It's not necessarily for you if you want a full exit and walk away. But if you're willing to sort of realize some of your investment and actually go through the process with private equity, I think it can be quite lucrative. As I said, it looks like we are running out of time. I will turn just to see if there are any extra questions. No extra questions. Brilliant. All right. Well, I'd like to thank Chris, Daniel, and Marcus. Thank you very much for your insights. I'd like to also say that we will be back next year with more private equity webinars. If you have any suggestions and things you want to understand or know further about private equity, please feel free to send those through, because this is really about us sort of getting closer to our clients and the community and understanding what private equity can bring to the table. So on that note, I will say thank you very much, everyone.
Thank you.
Thanks, guys.
Thanks.